Good afternoon. Welcome to Kenya News Update today. I'm your host, and we're taking our global lens to the Southern Hemisphere this afternoon, where Australia's latest inflation data has just landed with a significant thud. The headline number: consumer prices rose 3.6% in the fourth quarter of 2025. That figure, while meeting market expectations, marks a six-quarter high for Australian inflation. More importantly, it firmly entrenches price growth above the Reserve Bank of Australia's target band of 2 to 3%. This single data point has effectively slammed the door shut on hopes for interest rate relief this year, reshaping economic forecasts from Sydney to Perth. But what's driving this persistent pressure? And what does it mean for the average Australian family, for global markets, and for economic policy worldwide? We're diving deep for the next 12 minutes. Let's first put this 3.6% figure into its proper historical context. To understand where we are, we need to see the journey. Australian inflation peaked at a staggering 7.8% back in late 2022, in the wake of the global pandemic's supply chain chaos and energy shocks. From that zenith, it began a steady descent, cooling to 5.5% by the end of 2023 as the Reserve Bank's aggressive rate hikes started to bite. The decline continued through 2024, with inflation dropping to 3.2% in the first quarter of last year, briefly dipping into the RBA's target range. But then, the trend reversed. It ticked up to 3.8% in Q2 2024, moderated slightly to 3.55% in Q3, and has now climbed again to this latest reading of 3.6%. This isn't a blip, it's a clear, concerning plateau well above where policymakers want it to be. The quarterly breakdown is equally telling. The Consumer Price Index rose 0.6% from September to December 2025. While that might sound modest, it annualizes to a pace of nearly 2.4%, contributing directly to the stubborn annual rate. Digging into the components reveals the story. The so-called trimmed mean inflation, which strips out the most volatile price movements, held steady at 3.2%. This core measure is what the RBA watches most closely, and its persistence signals that inflationary pressures are broad-based, not just tied to a few erratic items. Furthermore, the weighted median, another key gauge of underlying inflation, came in at 3.1%. Both core measures remain squarely above the midpoint of the RBA's target, painting a picture of entrenched price pressures that will be difficult to dislodge. So, what's fueling this fire? Economists point to a perfect storm of domestic and international factors. Domestically, services inflation remains stubbornly high. Think about your haircut, your gym membership, your restaurant meal, or your child's tuition. These are areas where prices are notoriously sticky. They go up easily but rarely come down. Wages in Australia have been growing at their fastest pace in over a decade, with the wage price index recently hitting 4.2%. While good for workers, these rising labor costs are being passed through to consumers in the form of higher prices for services. Housing costs are another major driver. Rents across the country's major cities continue to soar due to a critical shortage of rental properties and record levels of immigration. Construction costs, though easing from their peaks, remain elevated, keeping new home prices high. On the global front, Australia is not immune to worldwide trends. While global goods inflation has cooled significantly, disruptions in key shipping routes and geopolitical tensions continue to create pockets of volatility for imported goods. Furthermore, the Australian dollar has weakened against the US greenback over the past year, making imports more expensive. This currency effect adds another layer of cost pressure, particularly for electronics, vehicles, and other imported consumer goods. Energy prices, while off their peaks, remain a wildcard. Any flare-up in the Middle East or further production cuts by major oil exporters could send petrol and electricity costs soaring again, directly feeding into the inflation basket. Now, let's bring in the first perspective, that of the central bankers. The Reserve Bank of Australia has been unequivocal in its messaging following this data release. Governor Michelle Bullock and her board have repeatedly stated that bringing inflation back to target is their paramount objective. The latest statement from the RBA meeting minutes reads, and I quote, "The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that outcome." In plain language, this means interest rate cuts are off the table for 2025. The cash rate, currently at 4.35%, is likely to stay at this restrictive level for the foreseeable future. Some hawkish members of the board are even openly discussing the potential need for further rate hikes if services inflation does not show clear signs of moderating in the coming quarters. Their argument is simple: the credibility of the central bank is at stake. letting inflation expectations become unanchored, where businesses and workers simply assume high inflation is the new normal, would be a catastrophic policy failure, requiring even more painful medicine later. But this hawkish stance is not without its fierce critics. Let's turn to the second perspective, that of households and business advocates. For the average Australian family, the RBA's higher for longer interest rate strategy is a source of immense financial pain. Mortgage holders are bearing the brunt. With the vast majority of Australian home loans on variable rates, each month brings another hefty repayment. The typical borrower with a $750,000 mortgage is now paying over $2,000 more per month than they were before the rate hike cycle began. This is money being sucked directly out of household budgets, crushing disposable income and consumer confidence. Retailers are feeling the pinch, with spending on non-essential items plummeting. Small business owners, who often rely on personal loans or variable rate business loans, are facing a double whammy of higher financing costs and weaker customer demand. From this viewpoint, the RBA is fighting the last war. They argue that the current inflation is largely driven by supply-side issues, housing shortages, global logistics, that are not responsive to interest rates. Crushing demand with high rates, they say, will only cause an unnecessary recession and job losses without solving the core problems. This debate brings us to the political arena, our third perspective. The inflation data lands at a delicate time for the Australian government. Treasurer Jim Chalmers has been walking a tightrope, trying to balance fiscal responsibility with cost of living relief. The government has pointed to its budget surpluses as evidence of responsible economic management, arguing it is not adding fuel to the inflationary fire through excessive spending. However, opposition leaders are seizing on the 3.6% figure as proof that the government's policies are failing. They argue that high immigration levels are exacerbating the housing crisis and putting upward pressure on rents, while proposed industrial relations reforms could push wages higher in an unsustainable way. The political battle lines are drawn. One side argues for patience and staying the course with independent monetary policy, while the other calls for immediate intervention to boost housing supply, cut immigration, and provide more direct relief to struggling families. The political stakes couldn't be higher, with the health of the economy being the ultimate battleground for the next election. What does this mean for the global economic picture? Australia is often seen as a bellwether, a commodity-driven economy with deep trade links to both China and the West. Its persistent inflation is being watched closely by other central banks, including the US Federal Reserve and the European Central Bank. If a country that raised rates early and aggressively is still struggling to tame price growth, it suggests the last mile of inflation reduction may be far tougher than anticipated globally. This reinforces the higher for longer narrative worldwide, potentially delaying rate cuts in other major economies. For financial markets, the Australian data has led to a repricing of expectations. The Australian dollar strengthened on the news, as higher for longer rates make the currency more attractive to yield-seeking investors. However, Australian government bond yields also rose, reflecting expectations of sustained tight monetary policy, which in turn increases borrowing costs for the government and corporations. Looking ahead, what are the potential scenarios? The base case, endorsed by most major banks, is that the cash rate remains at 4.35% throughout 2025, with the first cut not arriving until perhaps the first half of 2026. Under this scenario, inflation is projected to slowly grind lower, perhaps ending 2025 around 3.2%, still above target but moving in the right direction. The unemployment rate, currently at a low 4.1%, is expected to rise gradually to around 4.5% as the economy cools. This is the so-called soft landing path. The upside risk scenario is that inflation proves even more stubborn. A new spike in global oil prices, a severe weather event impacting food supplies, or a breakout in wage growth could push inflation back toward 4%, forcing the RBA to hike rates again, potentially triggering a recession. The downside risk scenario is that the lagged effects of past rate hikes hit the economy harder and faster than expected. A sharp rise in unemployment and a collapse in consumer spending could see inflation fall rapidly, potentially below target, forcing the RBA into an abrupt pivot to cutting rates to stimulate the economy. For Kenyans and our viewers across Africa, the Australian story holds relevant lessons. It demonstrates the long and difficult tale of an inflation fight. Even after the most dramatic price surges are contained, underlying pressures in services and housing can keep inflation elevated for years. It highlights the painful trade-off central banks must make between price stability and economic growth. And it shows how globalized our economic realities are. Shipping costs, commodity prices, and currency movements in one hemisphere ripple across to the other. As Kenya continues its own battle with inflation and navigates its monetary policy path, the Australian experience serves as a cautionary tale about the challenges of that final pushback to target. In conclusion, Australia's 3.6% inflation rate is more than just a number meeting expectations. It is a signal of resilience in price pressures, a directive for monetary policy, and a source of deep anxiety for households. It has extinguished hopes for near-term rate relief and set the stage for a prolonged period of economic restraint. The debate between the central bank's resolve and the public's pain is now the defining economic story of the year. The path forward is narrow, with risks on both sides. One thing is certain, all eyes will be on the next quarterly data release, searching for any sign that the tide is finally, definitively turning. For Kenya News Update Today, I'm your host. Thank you for watching. Subscribe to Kenya News Update Today.